Welcome back. We look now at the U.S., where interest rates are on the way up and the dollar is on the way down. Douglas George takes a look at what could be one of the biggest risks to the world's prosperity.
The front line in exchange rate volatility, this is where the currency movements in the last year have really made an impact. The cars are made in Germany, where the euro has surged over the last year to $1.30 US and over $10 Hong Kong. The sales manager winces at the thought of it all.
The gross profit vaporized. We haven't changed any price last year. In fact, during the competition, we have to lower our price. So what we are doing now in terms of the reaction to euro is nothing last year.
They responded by cutting costs not related to sales to avoid hindering the sales staff from selling what is usually up to 70 cars per month. Boosting volume helps. Still, the euro's steadily increasing strength cannot be resisted forever.
In 2005, are you going to absorb any more increases?
We will, but we will reflect some euro strength in our prices this year. Well, in the range from 5 to 10%. Yeah, and that's all the market doing now.
Most other Euroland importers expect to see similar price rises. Danny says every brand has a natural price ceiling. His company could come close to its own with the expected price rises.
We can't really generalize these effects across Hong Kong or even across Asia. In fact, some say a falling dollar is good for Hong Kong. Nevertheless, it doesn't put the brakes on the unease felt about a falling dollar.
This exporter hasn't felt any exchange rate pain in his business, though. 45% of his pots and pans sell in the U.S. His costs are mostly in U.S. dollars or Hong Kong dollars and renminbi, both of which are pegged to the greenback. And he's seen a nice upward exchange rate increment on his euro trade.
The weak U.S. dollar has, because the Hong Kong dollar is pegged, has some advantage to Hong Kong exporters when they export to economies or places where their currency are stronger. For example, the European market. Our European customers were able to buy because of their stronger currency capability.
While the euro has risen, the Asian exporters, Hong Kong, China, and Japan mainly, have tracked the dollar's demise, with their central banks accumulating up to 2.4 trillion US dollars.
A lot of this deficit is financed by Asian central banks, which are willing to purchase these assets in exchange for competitive exchange rate for their own economies.
The wish to remain competitive has also helped fuel the spending of the U.S. government and the American consumer. Much of what the U.S. buys on credit is financed by the Asian central banks. The unease about the present balance between Asia and America stems from the falling dollar. How long can the U.S. keep piling on debt, and how long can the Asian central banks keep buying ever-shrinking U.S. dollar assets?
One scenario would be if suddenly the Asian currencies decided really to dump the dollar, and this forced a very much sharper and steeper depreciation than we've had already.
Then there is a risk that demand for these U.S. treasuries will fall, and hence leading to a rise, or maybe a sharp rise, in U.S. dollar interest rates or bond yields, which could be quite damaging for the U.S. economy. Ultimately, if the U.S. interest rate does rise very sharply, I don't think Hong Kong can escape unscathed.
So far, that has not happened and isn't likely to happen, as any sell-off would naturally lead to greater depreciation of U.S. reserves. Even though their dollar buying plugs a budget gap, that doesn't mean the Asian economies have escaped criticism. Their tracking of the U.S. dollar has invited fierce opposition from American and European lawmakers. They would like to see the renminbi and the yen appreciate more. In the last 2 years, Japan and China have avoided the huge exchange rate adjustments experienced on the European side. The yen has strengthened, but nowhere near the amount it would have had the Bank of Japan not intervened in foreign currency markets.
So there is definitely a case to be made that the Asians, in some way, the Asian countries, primarily Japan and China, I would say China, have not borne any of the burden of this and have actually reaped the benefits, rewards of a weak U.S. dollar.
American and European lawmakers demand the renminbi appreciate against the greenback. Beijing responded that it is still premature. But they have eased the pressure by trying to slow the mainland economy down with austerity measures and imposed an export tax on trade flows to shrink its trade surplus, mainly to the U.S. But Tony Latter of Hong Kong U says the Chinese peg to the dollar is causing imbalances just to remain competitive.
I don't quite understand why they're reluctant to let the exchange rate appreciate. The economy would be better off if they had a slightly stronger exchange rate. That's my view. It would improve the terms of trade, it would make imports cheaper, it would reduce the monetary management, ease the monetary management problem. They would not accumulate so many foreign exchange reserves which they don't need anymore. And as an incidental to that, if you like, it would ease political tensions with the United States and other parts of the world.
China will only revalue by pretty much a token amount, 3%, 5%. I don't think that it will be sufficient to really correct that significant imbalance between the US and China.
Latter says the Chinese could go much further than appreciation.
Liberalize capital outflows more so that the upward pressure recedes a little bit and that the accumulation of trade surpluses is balanced by a greater capital outflow.
The downside is that the banks are in such a precarious position at this stage, and I think the Chinese government is well aware of that, that if they do open, it could have devastating consequences to those financial structure.
Mr. Speaker, the President of the United States.
On the flip side of the argument, the Asians say the U.S. could curb its spending. Bush made a surprisingly clear promise in his State of the Union address to get that process started.
I will send you a budget that holds the growth of discretionary spending below inflation, makes tax relief permanent, and stays on track to cut the deficit in half by 2009.
But critics say his new budget does not spell out a believable plan to cut the country's debt, now equaling 6% of GDP.
The only way to reduce the budget deficit is to cut government spending or to raise taxes. I can't see the latter happening in the near future, raising taxes, especially so soon after the election.
The wild card here, or the joker here, is obviously the spending in Afghanistan and in Iraq, and maybe possible future action on other countries.
But you can't reduce the deficit if you keep jacking up your military spending. But you must make sure that as soon as, hopefully, that tap gets turned off a little bit, that the thing will swing back towards balance.
And some of the pressure will be eased as the Fed continues to raise rates. Last week, the Federal Reserve pushed short-term interest rates slightly higher, part of a slow-motion campaign begun last June and expected to continue well into this year to keep inflation and the economy on an even keel. Fed Chairman Alan Greenspan and his colleagues raised the target for the federal funds rate by 1/4 of a percentage point to 2.5%, in the 6th increase since last summer. Eventually, those rate hikes could filter through to Hong Kong.
On the bearish camp, you have people saying that Hong Kong interest rates could rise as much as 4% this year, and the Fed funds was to continue raising rates at every opportunity. I think that's much too pessimistic. We've seen no signs so far that Hong Kong interest rates are required to follow suit.
As these scenarios play out back in Wan Chai, euro importers like Danny believe Hong Kong's economy is on the upswing and that eventually, once they make up their minds, consumers will decide to buy what they want, but always with an eye on value.
Oh, there's a big potential and the buying potential there. But people do shop around and wait for the best moment to buy. And they're waiting for new models, especially these 2 years, then new models coming up. And then new models usually come with new features. And then they don't, and us, importer, cannot and will not increase the price much.
And that is Money Magazine for this week. Thanks for joining us. Good night, and Gung Hei Fat Choi.